and the likes. Today we'll be discussing a very important topic, one that we think is often overlooked, but it's really important that people should talk about, which is understanding your risk appetite, basically finding the right investment style for you. We understand today in the market, whether you're just starting your investment journey or you're looking to refine your strategy, it's important to understand your risk appetite. It's important to understand what works for you. It's important to define your own journey, especially in today's world where the market is filled with a lot of noise. There are a lot of today there are trending stocks, tomorrow there are trending investment opportunities. There is an ever-changing economic landscape, right? It's important that you don't get pulled into different directions. The key to long-term financial confidence isn't just choosing the right investment for you, it's basically choosing the right investment style. So that's part of what we'll be discussing today, basically helping our attendees, helping our customers to understand the best investment style for them. And we have great panelists who will be doing justice to this topic. We have keynote presentation, and then, of course, we are on standby to take your questions. Whatever questions you have to understand your risk appetite, your investment journey, whatever guide that you need to go as you begin to invest. The goal is everybody wants to build wealth, but you have to do it in a way that you are safe, your finances are safe, and there are no issues. Without wasting much of your time, we would proceed straight to have a welcome address by Olusegun Owadokun, who is Deputy CEO of Coronation Securities. Good morning, good afternoon, Segun.
Yeah, good afternoon, Vincent, and thank you so much for the opening introduction. And thank you so much, everyone, for joining us for this webinar. Once again, good afternoon, distinguished guests, colleagues, and valued participants. We do not take it for granted that you've taken time out of your busy schedules to join us this afternoon for this very important topic. This is something we do regularly at Coronation. We try to empower our clients and our stakeholders generally regarding in terms of financial literacy and investment knowledge. So, good afternoon once again. My name is Olusegun Owadokun. I'm the Deputy Chief Executive Officer of Coronation Securities Limited. It is both an honor and a privilege to welcome you to today's highly very relevant topic and webinar. Before we proceed, let me begin by thanking each and every one of you for making our time to be here with us today. Your presence actually reflects a shared commitment to inform strategic investing, and this is a commitment we deeply value. At Coronation Securities, we firmly believe that financial empowerment begins with knowledge. This conviction has driven us to create platforms like today's session, which is designed to spark meaningful dialogue, deepen financial literacy, and empower you with the confidence to make sound investment decisions. Our theme today is both timely and very foundational, and that is understanding your risk appetite, finding the right investment style for you. This isn't just a topic, it is the cornerstone of sustainable investment success. In today's dynamic market, real advantage lies not only in where you invest, but essentially how, and which is in alignment with your unique financial personality and risk profile. All too often, investors follow trends that do not suit their actual risk appetite for risk. Today's session is dedicated to bridging that gap, which is helping you understand yourself as an investor and equipping you with tools to build an investment strategy that is essentially tailored to your journey. In today's session, we're actually privileged to host an exceptional faculty of industry leaders. We'll be starting with our keynote speaker, who is Mr. Nathan Nwokoro, CFA. Mr. Nathan Nwokoro is actually the Chief Executive Officer and founder of Savers Financial Services Limited. He will be coming with a deep insight into investor psychology. Also, we have in our midst, as one of our panelists, Ms. Nkechi Obi, who is currently the acting head of operations at Lagos Commodities and Futures Exchange. She will be bringing to bear a regulatory and operational lens to this discussion. Also, we have as one of our panelists, Mr. Ahmed Banu, CFA, who is currently also the managing director of STL Asset Management Limited. He will share with us his strategic perspective from an asset management space. And the last but not the least is one of our own, my colleague, Mr. Olufemi Yoloye, who is the Chief Executive Officer of Coronation Wealth. He will bring to bear a wealth of experience from within our group, providing guidance on aligning investment with long-term financial goals. Today, and collectively, they offer a well-rounded view from regulation to operations to portfolio strategy. Whether you're an experienced investor, a financial professional, or just starting your investment journey, we are very, very confident that their insight will be practical, applicable, and empowering. Once again, thank you so much for joining us. Your participation is invaluable to us. We hope today's conversation leaves you not only better informed, but also better equipped to make confident, purpose-driven investment decisions. So let's begin. I'm really very excited for us to begin so that we can have a very, very fruitful and a useful deliberation. Thank you so much, Moniki, for joining us. And I will hand over to our moderator, Vincent, to take over from here. Thank you so much.
Thank you very much. Thank you very much, Segun, for that wonderful welcome address. Just as he has said, this topic is very foundational. It's important that you understand your risk appetites, especially in the kind of situation that we are in, especially when people talk about investments. In fact, in every circle today, there are conversations around investment. Oh, your friends are not investing. There's this new deal. What kind of sometimes when we read research or listen to analysts, there's so much talk about stock, about the kind of investment opportunities available, but you need to understand your style, no pressures, which is what this webinar is going to do, to make you understand your own investment style, no pressures, and how you can build your own wealth with your own pace and following your own style. So we'll move straight into our keynote address. I'm introducing the keynote speaker, just as Mr. Wadokma had said. Our keynote speaker is Nathan Nwaokolo. Nathan is the Chief Executive Officer and founder of Savers Financial Services Limited. He's a corporate investment advisor. He's an interdealer broker licensed with the Security and Exchange Commission. He has over 2 decades of experience in the financial service industry, starting his career at Zenith Bank, where he spent 11 years developing expertise across various areas of commercial banking. In 2017, he joined Cowrie Asset Management Limited, where he played a pivotal role in expanding the firm's investment management operations. His work involved serving individuals, families, and institutional clients across wealth management, trading, and advisory functions. Since founding Savers, Nathan has led the firm to obtaining SEC licensing as both a corporate investment advisor and interdealer broker. And under his leadership, Savers empowers clients to navigate complex financial decisions, particularly in multi-generational wealth planning, security trading, family governance, succession, and estate planning, retirement strategy, and long-term portfolio management. Nathan serves on the investment committees of several institutions and is widely recognized for his visionary leadership, professionalism, and unwavering commitment to client success. As was previously introduced, he is a chartered financial analyst, CFA, and a member of the CFA Society in Nigeria. Good afternoon, Nathan. I think that if there is anyone, who can give us, we're in safe hands really with the CEO of Savers giving us his keynote address to help us understand our risk appetite and find the right investment style for us. So over to you, Nathan. Good afternoon.
Good afternoon, Vincent, and good afternoon, everyone. I want to start by really thanking Coronation Securities Limited for giving us this opportunity this afternoon to discuss something I consider very important and very timely. I say it's important and timely because, as it's been alluded to earlier on by Vincent and Segun, we live in a very interesting time today. If you look across markets, whether you are looking at the domestic market or the global equities market, and even cryptocurrencies, if you look around you today, most markets are trading at all-time highs. You look at Bitcoin, just recently saw the price cross $120,000 per Bitcoin. I think it touched about 122,000 recently. I don't know what it is now, but it's hovering currently around $120,000. You look at the stock exchange, the Nigerian Stock Exchange. In the last couple of months, in fact, in the last 3 years, the market has returned in 2023, 2024, and this year, we've seen outstanding returns from the Nigerian stock market. Currently, the level has crossed 100,000 points. We are heading to 130,000 points as of yesterday. You look across the global market, whether the S&P 500 or just the global stock market, we are trading near all-time highs. And the question you get to ask yourself is this: what is driving all of this? Now, interestingly, if you speak to brokers, the number of people who are creating new accounts has dramatically increased this year, this 2025, compared to the last 5 years. There are more and more people who are interested in investing today compared to the last couple of years. So what is driving this interest in investing? Is it what British economist John Maynard Keynes describes as animal spirit? Or is it as a result of well thought out investment plans? I think that is what the question this webinar, one of the questions this webinar seeks to address. The whole interest we are seeing in the market today, what is driving it? Is it the herd behavior, bandwagon effect, or are we really seeing this interest as a result of disciplined approach to investing? So, if you look through time, the human mind works in interesting ways, So, one of the questions we get asked very often as professionals is this: is this a good time to invest? Or what is the best investment to have at this point in time? Really, and to be honest, you really do not have an investment you can point to at any point in time and say, this is the best investment to hold at this point in time. It comes down to what suits you. And one of the things that is important for us to note is this: that in these times we live in, and even through your course of investing, if you don't understand who you are as an investor, the market is not a place to find out who you are as an investor. It's not the market. You have to know yourself before coming into the market. You do not come into the market to find out who you are. And as Tel says, one of the most difficult things to do in life is to know yourself. And when it comes to investing, there is no strategy that suits everyone. So finding out who you are, it's very important. And to me, it comes down to 3 things. First of all is identifying what your financial goals are as an individual, and then understanding your ability to take risk, which is one of the key things we are going to be discussing today. And then knowing your limitation, because as humans, our behavior is our biggest limitation when it comes to investing. It doesn't matter if you start investing today, as I just described, markets are trading at all-time highs. Now, some person may argue that it's the wrong time to start investing, that you rather wait till the market dips. But to me, there's nothing like that. There's nothing like a right time. If you want to start investing today, all you need to do is to have a solid plan and have a good understanding of yourself, your traits, and what works for you as an investor. Once you have this understanding, you can invest at any point in time. You can start investing today and run your strategy over the long term. 3 things I need to point out about the human mind, which to me is what really drives the animal spirit that I described just now, is that the human brain is designed to point us in the wrong direction by default. It's designed to point us in the wrong direction. And that is because the human brain works in a way that is meant to defend man from physical harm. It's funny, but that is how our brain works. At every point in time, once the brain sees danger, it goes into a defense mode. And because of this, you do not always get the best decisions if you rely wholly on your emotions. So first of all, the brain is designed to respond to threats. And that is why you see certain investors, when there's a market downturn, the next reaction is to sell down. Once there's a market downturn, is the brain's way of protecting you from danger. The brain senses that there's a market downturn and there's danger. So the first reaction you get from your brain is sell. So as an investor, you do not want to be taking decisions based on fear, regret, which is very prevalent today. A lot of people invest with regret as a leading decision mechanism for them. So you hear a stock has added 60%, and the next thing is, I want a slice of it. Bitcoin is at 120,000. Yes, people are making a kill out of Bitcoin today. Everyone wants a part of that market. So people don't want to miss out on these trends. And then finally, the brain is money hungry. The human brain is money hungry. There was a statistic that came out recently, and what we saw is that the most visited sites in Nigeria as of May this year is Bet Niger. It's the most visited site in Nigeria, and it's only natural. The human brain is money hungry, and anything that promises a high return or a high payoff is interesting for the brain, and the brain wants to be part of it. So you have to be aware that we have these limitations as humans. Most decisions, the brain wants you to take based on fear, regret, and greed. And when you base your investment on these emotional drivers, then you are just in a survival mode at every point in time. And it's really dangerous running an investment program with emotions. So it's important to understand how we respond to risk as individuals. First of all, that your brain is designed to mislead you. But once you are aware of these limitations we have as humans, then you are better positioned to take better decisions around your investment. So I listed a couple of things that shapes our personality, our risk personality as individuals. No two investors are the same. And you need to understand what drives you as an individual. The way someone who grew up in an affluent home sees risk would always be very different from the way somebody who has a poor background would see risk. It's going to be completely different. So you need to be aware of your background as an individual And there are people who just have cognitive issues, like maybe that you do not even have the time to for due diligence when it comes to investing. So you need to understand all of these market conditions, social influence, whether we like it or not. Many of us are swayed by what we hear from peers, from the media. Whether you like it or not, whether you admit it or not, that is what drives most investment decisions. Maybe as a result of discipline and experience, you have a way to overcome this social influence. But truthfully, most people are driven by what they hear, what's going on today, past experiences. And in fact, you speak with people who invested through 2007 to 2010. Many of such investors have an aversion for investing in stocks. And you cannot blame them. It comes from a place of experience. Because they've been hurt before, the brain's reaction to investing in equities or risky investment is avoidance. But that doesn't make it right. It's just who you are, and it's shaped by your experience. And then you think about knowledge. It's important to have, the more knowledge you have as an investor, the better you are positioned to navigate risk as an individual. The less knowledge you have, the less understanding you have of the investment market, the worse off you are. And I mentioned cultural and personal values. Our background has a profound impact on how we perceive risk. Very profound impact. If you see an investor, if you work with an investor who grew up in a poor background, such investors often has some level of risk aversion. They don't want to take risks because the brain always reminds you that if you take excessive risk, you may find yourself back where you do not want to be. So all of this plays a role in our disposition to taking risk. And successful investing starts from understanding yourself. If you have a high level of risk aversion, or you have a large appetite for risk, none of this is better than the other. The problem starts from when you start pretending to be who you are not. And we see it every day. If you are someone who has a low tolerance for risk, and today everybody is claiming to be a trader, everyone today wants to give investment advice. Everyone suddenly today has a stock on their recommendation list that they want you to buy. Now, if you move away from being a long-term investor, if that is who you are, and suddenly become a speculative trader, then you are deviating completely from who you are. If your basis for making investment decision is that a particular asset has made substantial returns, then you are setting yourself up for trouble. And this is what happens when your investment is misaligned, meaning that you are investing with a strategy that is different from your personality type. What happens is that if there's a downturn, you are likely going to panic and sell. And today, I just described that markets are trading close to all-time highs or at all-time highs, depending on where you are looking at. Now, the danger we face today is the fact that downside risk is very high. Like I said, there's nothing wrong with investing at a time like this, but you have to have a strategy coming into the market today. If you have no strategy and you're just investing because of the trend, what we see on the news, there's a high chance that if there's a downturn, you're going to panic and sell. And when you sell and make losses, the brain's reaction will be to avoid completely everything that has to do with investing. Because the brain feels hurt, you feel hurt that you lost money, and the next thing is to abandon investing altogether. And unfortunately, a lot of people are in this circle constantly through their investing career. A lot of people constantly are in this circle. If you ask most people what their strategy is buy low and sell high. But in reality, that is not what most people do. Most people start investing at market highs and then sell when there's a downturn. And then it's repeat and rinse, repeat and rinse most of their career. So the question we need to ask ourselves as investors is, where do you fall on the risk spectrum? Most professionals, advisors, investment managers like to put investors in three different brackets: aggressive investors, moderate investors, and conservative investors. Now, for you to determine where you fall on the risk spectrum, you need to ask yourself certain questions. First of all, it starts from your goal as an investor. What really is your goal? What are you investing for? Are you investing for retirement, for instance, or you are investing to buy a house or build a house in 2 years? These two goals have different risk profile to them. If you are in your 40s and you are retiring in 20 years, your risk appetite or your risk profile will be significantly different from that of somebody in his 50s retiring in 10 years. And would also be different from the risk profile of an investor who is in his 20s and still has close to 60 years before retirement. So the next thing will be to review your time horizon. How long are you willing to invest? How long are you willing to invest? The longer you may be willing to invest, the more risk you can take. If you go back to the example of someone retiring in 20 years versus someone who intends to build a house in 2 years, the guy retiring in 20 years may be able to take more risk with that fund compared to someone who wants to build a house in 2 years. You may be able to take more risk, all things being equal. Then, very importantly, cash flow is a very important consideration when it comes to investing, but it's something a lot of people do not pay enough attention to. Your cash flow is important. As they will say, cash is a blood that flows through the vein of any entity, whether an individual or a business. Without cash, most entities are dead. So you need to understand your need for cash. If you have an investment and there's a loss on that investment, do you have the ability to wait? If you make loss on an investment, how is it going to impact your lifestyle? If investment losses will have a great impact on your lifestyle, then you should understand that your ability to take risk is limited. So you need to also understand your ability to take risk and then reflect on your past experiences as an individual. One thing I'll always say is that if an investment does not allow you sleep well at night, no matter how good that investment is, it may not be for you. So some of us have experiences that makes us consider certain type of investments to be too risky and makes you restless. I just described those who lost money during the last market crash in 2008, 2009. For many of such investors, when you speak to them and you mention stocks, it's like a no for them. So you have to understand that part of yourself. If an investment would not allow you sleep well at night, to me, it may not be advisable to get involved in such investment, no matter how much return is promised, or no matter what anybody, including professionals, say. Then age and wealth status is very important. So older investors typically can take more risk than younger investors. I say typically. Of course, there are older investors that have significant amount of wealth, and that allows them to take even more risk than younger investors. Then one aspect that I think we overlook, especially as individual investors, is the role that professional support plays. You can't take that away. Most people try to do it themselves. But with the most professionals have sufficient resources to help us set up a solid investment strategy, set up a solid plan, and then work through such plans. And one of the tools that professionals will make available to you is a risk assessment questionnaire, which will immediately pinpoint your risk capacity and then give you advice on the sort of assets that you should be looking at. So the whole idea around understanding your risk appetite and investing accordingly is to minimize, not completely avoid risk, but to minimize the impact of market volatility in your portfolio and to help you achieve the best returns possible. Now, so depending on where you fall on the risk spectrum, you're going to have what looks like an allocation that looks like, this is the classical 60-40 portfolio where investors have 60% in equity and 40% in bonds. Most young people start out investing with a portfolio that looks like this. But today, the concept of risk is rapidly changing. Before now, when you speak of risky assets, you're just talking about stocks. But today, there are a lot of evolving asset classes that can be classified as risky assets. So you're not just talking about stocks, you're talking about high yield bonds. Many of us would remember people who invested in Ghana Eurobond, which was recently reorganized, and a lot of investors lost value investing in those junk bonds. So high yield bonds, ordinarily bonds will be classified as less risky assets because they carry the fate of sovereign bonds, that is, carry the fate of a sovereign government. But some of these bonds have very high risk component to them, whether it's currency risk or default risk, and even credit risk. So high yield bonds will be described as risky assets. Then you look at commodities, crude, copper, gold, agricultural products, and most recently, we have cryptocurrencies and digital coins. Most of us who are very conservative, old school type of investors, we are not very much in tune with what is going on with the crypto and digital coin market. But there are a lot of young investors that will swear and die by crypto and digital coins. So today, crypto, with talks of improved regulation, have become very important components of many portfolios, especially among young people. So, and I think it's, when you talk of risky assets, we need to pay more attention to how investors are adding crypto and digital tokens to their portfolios. Now, just to mention, I would not, this is a personal opinion anyway, if I'm managing a portfolio, for most portfolios, you shouldn't be doing more than 5% in crypto. And I say this because of the level of volatility in that market. We are going through a phase today. We don't know what happens in 2 years, in 3 years, in 5 years, in 10 years. We don't know what is going to happen. But as of today, based on what we know, that market is still very volatile. And as an investor, you want to be careful how you add it to your portfolio. And what really works at the end of the day is that as an investor, when you are talking of identifying a style, to me, is adopting a strategic approach. And there are three key elements to having a strategic approach. The first to me is that you need to have a well thought out plan that is tailored to your circumstances. So we already spoke about understanding yourself. Now, when you understand yourself and your risk appetite, the next thing is to have a well thought out plan that speaks to your risk profile. And then very importantly, as an investor, a strategic investor, you need to play the long game. Short-term investing historically has not proven to work well for most people. So having a long-term approach to investing is very important. And it's always about time in the market, not about how well you're able to time the market. I say this, that investing today is possible. All you need to have is a strategic approach. And the strategic approach starts from having a clear objective of what you are trying to achieve. You need to find out what you are investing for. And for me, this question almost always knocks many investors I work with off their feet. When they say, I have this amount to invest, advise me on what to invest in. When you ask the next question, what are you investing for? You typically see a pause because most people are not even prepared for that question. So you need to be clear with what you are investing for and then understand your risk appetite. Based on this, you are going to have an asset allocation that is split between risky assets and less risky assets. Then diversification is very, very important. And as I said, having a long-term mindset, a disciplined long-term mindset would help you a great deal. What this allows you to do, having a strategy and a long-term mindset, is that you are not going to be changing your strategy at every point in time. If your asset allocation says that you can only have 20% in stocks and 80% in bonds, if you are disciplined, you are going to stick to that strategy. You are not simply going to increase the allocation to stocks because you hear today that stocks are doing better than bonds. Instead, you may even end up selling off some of your stock allocation because their valuation may have become too high to preserve that 20/80 allocation that you have. And then there's need for regular review and balancing. Now, as I did say, at the end of the day, what you are aiming for is to be able to identify which part of the spectrum you fall. Are you a conservative investor? Are you a moderate risk investor? Or are you an aggressive investor that is able to take more risk? And what you see here is not an investment advice. It's just for illustration purpose. If you're a conservative investor, it's likely that your risk tolerance is low. It's also likely that you may have very high liquidity needs. And it's likely that you may have a short investment horizon. And then you should then have a moderate return expectation. Typically, older investors, as I said earlier on, are classified as conservative. More allocation to high quality bonds, because as we just said, even within bonds as an asset class, Some are riskier than others. Then your allocation to risk asset will be much smaller and could include equities and other alternative assets like stocks, bonds, high yield bonds, cryptocurrencies, commodities, and the likes. Then for moderate investors, you also have a moderate profile, typically middle-aged investors with modest level of wealth. For moderate investors, there's a split between risky assets and less risky assets, like treasury bills and high-quality bond. It's more like a 50-50 kind of split between those two. And then for aggressive investors, it means you have ability to take a high level of risk. Typically, younger investors that have high levels of wealth, you should have a long-term investment horizon and a high tolerance for risk. For such investors, you could have more allocations to equities and alternative assets. Now, in closing, there are things I need to point out. First of all, staying invested is more important than sitting on the sideline. Many people hold out for too long, sit on cash, and suffer decision paralysis. So you could have an investor that is sitting on cash for 2 years, looking for the best time to invest. Sitting on the sideline is not a good idea. It's better to stay invested always and than sit on the sideline. I did say that there's no best time to invest. Even at market highs like this, you can still invest. What helps you overcome volatility and downside risk is dollar cost averaging. For instance, if you're interested in buying a GTB today, it's currently 120. What is the risk of buying a GTB stock today? The risk that it goes down to 60. But if you're a believer in dollar cost averaging, you're going to buy at 120. If it comes down to 60, you buy more. It goes up again, you buy more. At the end of a long-term horizon, you look at your average price and you have less downside risk. Your average price is going to always be lower than the highest price. It's just somewhere at the middle between the highest price and the lowest price over that time frame. Diversification is also very important, and understanding your risk threshold. Then very importantly, at a time like this, investors should be paying attention to company fundamentals. Over the last couple of weeks, some of the best performing stocks on the NGX are stocks we've not heard of for a very long time. I know a stock that has done over 200% this year alone, over 200%. And this particular stock, if you look at their financial results, 2023, 2024, zero revenue. I'm not saying zero profit after tax. I'm saying zero revenue. It means that they sold no product in 2023 and 2024. But somehow, that stock is doing over 200% this year, 2025. What is driving that trend? Is it animal spirits? Is it bandwagon effect? Or is it just gambling? So this is time to pay more attention to fundamentals. For any investment you are choosing, look at the fundamentals. And very importantly, the tendency times like this is that a lot of people are going to go out, borrow money to invest because you are seeing the returns. Bitcoin is doing whatever percent is done this year. If I borrow a little money and buy more Bitcoin and I achieve 60%, I can pay off my loan and the difference, I go off and party with the difference. But understand that at times like this again, margins account are the highest. Everyone wants to borrow to buy assets. When there's a downside risk, the reverse would be the case. People want to sell off to pay off their loans. And when that happens, you'll be losing on two fronts. One, you are losing from the investment on the investment side, and you also have to pay interest on the loan. So using margin accounts at a time like this that markets are trading near all-time high is a very dangerous game. And as investors, you need to be careful how you use margin loans. And finally, it's important to have a long-term view. Most people will say they are long-term investors, but in practice, it's difficult to implement. And as Brian Ferrodi will say, the price for long-term outperformance is short-term volatility. At this point, I hand over back to Vincent to proceed with the rest of the discussion.
Thank you very much, Nathan. Thank you for that wonderful keynotes presentation. You covered a lot of grounds there. A lot of things stood out for me, and I'm sure stood out for our attendees as well. You talked about no two investors being the same. It's important that people know that no two investors are the same. You talked about having a long-term mindset, talked about understanding our risk threshold and the importance of diversification. And very important, you talked about not changing strategy in your asset allocation, because some people are moved by that. I'm sure when we get to our panel conversation, we would have that discussion around not changing strategy and how you can even create. I'm sure maybe some of our attendees are wondering what exactly an asset allocation is, even in the world of trading equities. I know for us at Coronation, there's something like a model equity portfolio and all that. So I'm sure when we go into our panel conversation, we'll have further discussion on how our attendees can build their risk appetite, how they can understand their risk appetite in this goal to build and sustain their wealth. We will move straight to our panel conversation now, but just before that, we'll pull up a poll now, basically to understand the risk appetite of our attendees and to just understand their investment experience, and of course, if they'll need some investment help from us to build their wealth, basically to help them understand the various investment options that are tailored to their risk appetite. Please, can we have the poll up now? All right, so we have the poll talked about, so you can just answer the questions, your level of investment, your risk appetite, and of course, if you'd want some free consultation from us on investment options tailored to your risk appetite. While the poll is going on, we'll just introduce our panelists for the panel conversation. Our first panelist is Banu Ahmed Olaitan. Ahmed has over 18 years of cognitive experience spanning investment management, stockbroking, and securities trading, institutional trusteeship, capital market operations, and other financial services. Before joining STL, Ahmed was the acting managing director and chief strategist at Parthian Securities Limited, where he led the brand transition of the company to align with the parent company's brand and created a business framework to drive competitive edge within the industry, taking the company from 0 to 1. Previously, he was the head equity investment at Stanbic IBTC Asset Management Limited. And also at Stanbic, he successfully managed various equity-based mutual funds and portfolios with a total AUM of 30 billion, delivering positive average annual returns to investors while outperforming a great benchmark. He is a chartered holder of the Chartered Financial Analyst CFA Institute, and an associate member of the Chartered Institute of Stockbrokers, CIS, and a certified international fixed income and deliverables dealer. Ahmed is currently the managing director of STL Asset Management Limited. Good afternoon, Ahmed.
Good afternoon. How are you doing today?
Very well, very well. Thank you for joining us. We'll introduce our next panelist, Nkechi Obi. Nkechi is acting head of operations at the Lagos Commodities and Futures Exchange. She's a seasoned operations manager, project management expert, communications, and brand enthusiast. She's an accomplished human resource professional with a track record of delivering strategic and operational excellence across sectors and continents. Nkechi holds a bachelor's degree in pharmacology from the University of Lagos and a master's degree in international human resource management from the University of West of England, Bristol, UK. Nkechi she played a pivotal role in foundational operations of the Lagos Commodities and Futures Exchange, LCFE, which is Nigeria's first tech license exchange list to list and trade physical gold assets. She has contributed extensively to the development of critical frameworks, including rules formulation, contract structuring, trading systems, and broker-dealer regulations that underpin LCFE's current operations. Rising through the ranks, Nkechi currently serves as the acting head of operation. In this role, she oversees core units including asset classes, agriculture, oil and gas, currencies, and solid minerals, and also trading and settlement, capacity building, and communications, among others. She also serves as the director of projects at Ninos Global Technology, Nigeria and the UK, where she has led multidisciplinary teams to successfully execute over 100 technology-driven products across the UK, Nigeria, and other regions. She's a chartered personnel management manager, CIPM, with a strong passion for mentoring entry-level professionals and young graduates, equipping them with skills and confidence needed to successfully navigate and thrive in the workplace. Good afternoon, Nkechi. Nice to have you here with us.
Good afternoon, Vincent, and good afternoon to our attendees and fellow panelists. Thank you for having me.
All right, so we'll dive straight in. Nathan has said so much about risk appetite. He has said so much about the different classes of investors. Talked about being conservative, being balanced. Talked about asset allocation and whatnot. But we'll just go straight to the questions. Before that, I think I have to introduce our final panelist, who is the CEO of Coronation Wealth, Olufemi Oloye. You know, I joked with Femi before now that his bio was 2 shots, and I'm sure that's why we couldn't see it. But of course, Femi is the CEO of Coronation Wealth. He's a versatile professional with over 30 years experience cutting across payments, communications, media, technology, business analysis, credit underwriting, and domestic financial markets. He currently drives the strategy towards the company's digital transformation. I think that this bio is very modest and very humble. That doesn't speak so much about who Femi is. Femi is a jack of all trades and a master of all of them. So good afternoon, Femi. Nice to have you here.
Good afternoon, Vincent. Good afternoon, panelists, and good afternoon, attendees. Pleasure to talk with you.
All right, thank you so much, Femi. We'll start our first question from with Ahmed. Right, a lot has been talked about risk appetite and all, but very, very important. How do you distinguish between risk appetite and risk capacity? Practically, how can you distinguish between risk appetite and risk capacity?
Okay, thank you very much, and good afternoon, everybody. So risk appetite and risk capacity, same, and I'll say same terminologies, but different concepts. Both are in the line of risk. So what's risk tolerance? Risk tolerance is the level of risk that you are willing and able to take in order for you to achieve your financial goals. Now, what is risk capacity? Risk capacity is it's an eventuality. I'll call it an eventuality. What do I mean by eventuality? After you have done your risk analysis, after you have analyzed your business using different risk analytical tools, then you can now determine the maximum amount of risk that you should be taking in order for you to avoid blowing up your capital or shooting yourself in the leg, if I put it that way. So I would say risk tolerance is an evaluation before you start to invest, while risk capacity is the output of or a determinant of your analysis of your risk levels in order for you to determine if you shouldn't go in excess of it or not. So that if you go excess of your risk capacity, then you might probably be overshooting yourself or blowing up your capital after a very short period of time. So yeah, so that's pretty much the difference between risk tolerance and risk capacity. In some quarters, they say your risk tolerance is subjective. While in some quarters, they say your risk capacity is objective. So it depends on how you look at it. But in terms of investing, what you are technically, as Nathan has mentioned while giving the opening, the speech, is that your risk tolerance is very, very, very important before you start to invest. You need to determine your risk tolerance. You need to determine your willingness and ability to take risk. Because if you don't know that or haven't determined that, you might probably not be creating an optimal portfolio for yourself. And when I say optimal portfolio, I mean a portfolio that suits your risk, suits your financial goals, and suits your investment objectives. So your risk and return, an ability for you to be able to achieve your financial goals.
All right, thank you very much, Ahmed. Just on that train of thought, I'd ask Nathan quickly, why is it important to understand who you are as an investor? Just beyond knowing the numbers. Why is it important to understand who you are as an investor beyond knowing the numbers? Nathan, you're muted.
Okay, sorry about that. Thank you, Vincent, once again. Understanding yourself as an investor is extremely important. Like I said earlier on, the market is not where to find out who you are. It's the wrong place to find out who you are. So before coming into the market, before you start your investment journey, it's extremely important that you understand exactly who you are. What is your identity? Are you a trader or an investor? And I think this is one thing that people confuse a lot. There's a difference between a trader and an investor. Traders are more short-term in nature than investors. An investor has a long-term outlook. There's a goal, there's an objective, and there's a strategy that seeks to meet that goal and actualize those objectives. But traders seek to exploit short-term opportunities. And the psychology and mentality that comes with this different philosophy is completely different. It's completely different. So you need to understand, first of all, who you are. Am I a trader or an investor? If I'm an investor, am I a short-term investor or a long-term investor? You need to have a clear understanding of where you fall. If you are a short-term investor, your approach to investing will be completely different. And I give a simple example. A lot of people invested in treasury bills over the last couple of years, I guess between last 2023 to this year. Most investors, all they wanted to invest in was treasury bill. But when you probe a little bit deeper, you find out that treasury bill may not be the optimal investment option for many of them, especially if you're a long-term investor. If you're a long-term investor and you're investing in treasury bill, it's not going to pan out well because you are carrying reinvestment risk. The risk that in a year, the treasury bill will mature, you need to reinvest. And as we see today, rates are dropping. So people who were hoping to reinvest today at 20-25% levels can no longer get the same rates. But such investors could have locked in long term. If you're a long-term investor, let's say you have a horizon of 10 years, you could have locked in the bond market, buy a 10 years bond. These bonds were trading close to 19-20% at some point. So you need to really understand your identity. Are you a trader or are you an investor? Are you a long-term investor? Are you a short-term investor? What amount of risk are you willing to take with your investment? What makes you sleep well at night? And what keeps you up at night? So you need to understand yourself. That it works for someone else does not exactly mean it's going to work for you. We are all different human beings. We have different background. We have different mentality when it comes to investing. And most importantly, we have different needs of what we want to achieve with our investments. And if you don't understand this about yourself, every investment alternative will look good to you.
All right, thank you. Thank you so much, Nathan. I think that's really spot on. Knowing that the market is the wrong place to find out who you are, it's really, really spot on. And of course, I think one of the biggest questions our attendees will go home to answer is, are you a trader or are you an investor? That's a very good question that you need to answer to yourself. Now, based on your thought around investors, I want to go to the next question for Nkechi. He's talked about investors, but the question now is, why do so many investors misjudge their own risk appetites? During his keynote presentation, he talked about how investors can change their asset allocation strategy because of some information in the market. So why do you think that investors misjudge their own risk appetites?
I thank you again, and good afternoon again. So one of the first things I like to say is I like to liken investment or investors to the world of farming and the world of agriculture. I'm coming from the commodities exchange perspective, so I like to use that analogy a lot. And one thing a farmer knows and a farmer does is having a good seed alone is not suitable for great harvest. So understanding the right elements, understanding the right soil. So the question now boils down to knowing where and how to put in your capital, where and how to invest, having that knowledge. There's no farmer that just plants anytime he feels like, just because he wants to. There's no farmer that goes into farming because 1,001 people are making a lot of money from harvesting paddy. It requires a lot of understanding. It requires a lot of knowledge, and it requires, like our speaker has said, understanding yourself. So I wouldn't say that investors, just like the keynote speaker has said, that have strategies, investment strategies, I don't expect them to ideally just misjudge their own risk appetite, because now your strategy is like your guide. It tells you who you are. It is a reflection, rather, of who you are, what you have, and what you intend to get us out of it. So the question now is, having that strategy, do they stick to it, or they just downloaded it from somewhere? Because now everybody has access to investment guidelines, and then you download a template and you want to run with it. And with every new shiny investment that comes out, you're finding yourself all over the place. And because you do not have a specific strategy, you do not know yourself, just like Mr. Nathan has said, you become part of people crying at the end of the day when everything crashes on your head. And then the question now is, oh, I thought you said you are an investor. What's happening? Yes, going into the investment market across board, the questions are always a lot. What areas am I going to go into investment? Am I sticking with the traditional elements? Am I going to touch a bit more of the alternative assets, like the commodities market? Am I trying to hedge my portfolio? Am I trying to, just take a bit of risk here and there? So, falling back to your question where you talked about why do they misjudge, I think the first thing would be that, one, there's no strategy. Going back to what Nathan has said, they do not even know themselves. So they don't know what they want. So they're most likely jumping on the bandwagon effect that, oh, okay, let's run to ABC investment. We all run there. Oh, it works. Yay. let's run to BDC and it fails, and then you've carried all the investment you've made from a legitimate place, put it in BDC, and everything is gone. So the lack of knowledge, lack of strategy, just jumping on the bandwagon, these things kind of affect investors, and probably I'm going to use the word leading them astray, because they are like, oh, I thought this was going to work. Oh, I thought I could risk this. But ideally, what they are telling you, if you're looking at them as an experienced investor, or as an experienced teacher or trainer in the space, is telling you that, okay, this person, one, either did not have a strategy, or two, did not stick to his strategy. So that will be. Thank you.
Thank you very much, Nkechi, and thank you for coming with, I mean, from the angle that you came in, from the agricultural angle, a seed alone is not just what will lead to a bountiful harvest. You need to know where and when to plant, and I think that also works with investment. Having all the money is not it doesn't mean that you're going to make so much more if you don't know the right strategies. I'll go over to Femi now. Let's bring this to technology, right? I'm sure a lot of people on this call, they really just want to know, how can I know my risk appetite? How can I know my tolerance level? They want to know. So how is technology improving the way that we can access and track investors' risk profiles? I mean, not just even the profiles in terms of from the traders or stockbroking companies' perspective, but even from an investor's perspective, what technology can they use to just even understand their risk appetite?
Okay, thanks, Vincent. So at the core, the tool will be something called a risk questionnaire. And it's simply put, it asks a couple of questions. Some of them may be gamified, some very direct. You can see a question like, if you have 1 million, are you okay with making 2 million for with the risk of losing half of it? Or do you want your 1 million to always be 1 million? Once you go through those questionnaires, there's one developed by the CFA. There are multiple all over the internet, and then you can always talk to the financial planners at Coronation Securities as well. After you answer those questions, it will give you a risk appetite. Typically, it's in 5 bands. At the extreme, it's what we call aggressive or very aggressive, different names across different platforms. And at the other extreme is what you call ultra conservative or conservative. Those that are aggressive are those that you see that put money in crypto, put money in penny stock for the upside that it could double. And those that are conservative are those that you see do fixed income. I put 1 million. I want to come back and meet 1 million plus interest. If other people made 20 million and they're 1 million, I'm happy for them. So there are tools. Basically, all of those things come under the bucket called a risk questionnaire, or a risk assessment questionnaire. Whatever brand the company calls it is up to the company. But on the back of that, I would tell everybody, please take one. Just even Google it while we're on the call. There's also one on the Coronation site. Just take one, see what your risk appetite is. Answer honestly, so that what Nathan, Banu, and Nkechi have said you won't be surprised. So people that do equities, for example, you put 1 million, it becomes 950. What they typically do is they close the app, or they bring more money to buy again. That's what Nathan described as averaging. If you're not an equities person, your 1 million becomes 950. You're on the streets of Lagos, you and VDM shouting, "Where's my money? The company must refund," and things around that. So leverage those tools, be honest in your assessment, and then run with it. Thanks, Vincent.
All right, thank you so much, Femi. Before I move over to Ahmed for a similar question, Femi, I just want to go to your next question. I want you to talk about Coronation's platforms, right? You've got a lot of people on this webinar, and you've talked about risk appetite and all. Certainly, you need to have, how your platforms, how Coronation platforms helping people personalize their investment strategies, and also, are there options for you to test the waters? For instance, I'm an investor today, or Nathan has said you're either an investor or a trader. So right now I don't even know. So how do I even know if I'm an investor or a trader? Is there a platform I can put some small money, real or virtual? I don't know, whatever it is, to test the waters.
Okay. Thanks. So with respect to platforms, I'll first start with something we call Coronation Research. It's people behind tracking bond yield curves, tracking commodity prices, tracking currency pairs and the likes. And then on the back of that, they come out with recommendations. I'll limit to stock now, since this is a securities podcast. They come out with recommendations. Say, buy this, sell that on the back of that. If you don't know where to start, you don't know what to do, as much as possible, look at those recommendations. It's not necessarily an investment advice. For an investment advice, you probably still need to sit down with someone. To come up with a simple recommendation, someone has probably looked at 10-year dividend payment history, 10-year financials, things that you just don't have the time or bandwidth to do. Once that is done, there's a web portal for those that don't have space on their phone to download apps. You can browse, you can see market prices, you can see what have you. Before all of that, we have what we call the Coronation Investment Academy. 500,000 Nigerians, almost 500,000 Nigerians are receiving training there currently. This is a webinar. Things like this ultimately move there. There are personalized trainings, at least with the two major exchanges in Nigeria. We've developed courses together. So you can do self-paced. You can shout that this is barely 2 hours to take it in. You can do self-paced. Now, after you've learned, it's always good to practice. We've just finished season 1 of the Fantasy League. Season 2 will start soon. There we give you virtual 100 million, virtual e-money, virtual 100 million. You go there, you buy 1 or 2 stocks, you see how it's performing, and then if you can't sleep at night because you are thinking of your fantasy portfolio, then clearly you know you have the wrong investment strategy, like they've pointed out. And then taking it further, when you've learned, you've practiced, or you've played, and you want to now start investing, you can talk to someone at Coronation. You can use the portal, or you can use any of our wealth apps, which is either the Coronation Wealth Plus, or if you're an Access Bank customer, it's just 1 click away from you. Thanks, Vincent.
All right, thank you so much, Femi. I think that was great. Talking about, just as Nathan has said, if you have investments that will not allow you sleep well at night, you need to not be there. So I'm sure that, of course, with virtual money on the Fantasy Fund, with the Investment Academy, which you can learn at your pace, I think those are great platforms that can help people even begin to understand their risk appetite and know what they can take. Ahmed, do you have, similar recommendations in terms of framework tools that you think will help people understand their risk tolerance?
So thank you very much for that question. I think it's pretty much in line with what Femi had mentioned. It's your risk questionnaire. There are different risk questionnaires. I think the whole essence of the risk questionnaire is to, okay, so let me backtrack. Now, when you talk about your risk tolerance, there are 2 things that drive your risk tolerance. There's the willingness and there's the ability to take risk. Now, the ability to take risk is what I always tell people, that is things we can measure. Yeah. So, e.g., your age, your wealth level versus your liabilities. So there's something I always like to call standard living risk. So which is, if you are earning a lot, but you are spending a lot, then it means that your ability to invest is predominantly very low. Your ability to take risk is very low. You have too many dependencies. So every time your salary comes every month, you are most likely paying 1 sister, 1 brother, 1 uncle. You are making allowance for your rent, your food, transport. By the time you look at it at the end of the day, you are pretty much have spent almost 98% of your salary. Yeah. So you are suffering for, or you even start to borrow. So that's where the likes of the PalmPay and the likes come in. Yeah. So my monthly expenditures are significantly larger than the money that comes into my account every month. Then I'm suffering from what I call a standard of living risk. Very soon you will blow up. So those are things you can measure. Another thing again is Yeah. So your age, yes, your age, younger people most likely should be able to take more risk than people that are a lot older or people at the level of retirement. So those are things. So in order for you to be able to determine your ability to take risk, those are those factors that you can sort of identify and sort of help you determine that. Now, the one that is very difficult to measure is the willingness to take risk, where the questionnaire comes into play. So I've seen instances where a client has a lot of money, like Nathan has said, he has a lot of money, but rather than this client investing in asset classes that will build his wealth, is most likely focusing on fixed deposits or treasury bills, most especially treasury bills, short term, exposing himself to investment risk, really not building his wealth. Fine, interest rates were high, but hey, if you think about it on a long term, as Nathan has said at the beginning of the year, treasury bills were doing almost close to 22%, but today they are doing 16%. Yeah. So we've seen clients over the years where they have the ability to take risk. However, they are not taking risk. And you have a lot of clients that they don't have the ability to take risk, but they want to take risk. What is really happening there is the willingness. So that's why a lot of people still go and Nathan mentioned something earlier. That's why a lot of people still bet. A lot of people still go to NaijaBet and NairaBet and all the betting agencies. But by the time you look at it, these guys, it is their last kobo that they are using to take that bet. And they really don't understand that betting entails a lot of risk taking. So in terms of ability, they don't have it, but they are taking risk. So that's where the questionnaire comes into play. So for professionals, and when we're making helping clients to create their portfolios, we need to analyze and identify your risk tolerance, risk appetite. So we know your ability, but your willingness is what we can't determine. So we give you a questionnaire. So it's predominantly a questionnaire. The questionnaire comes out with scores that we can use to, like as Femi had said, the output ranks over the very risk averse investor to the very risk-taking investor. Yeah. So by the time you spread that client or determine that client across that spectrum, you can technically know if the client's willingness to take risk is there. But one conflict that which I've mentioned, that we always find ourselves in is someone that has a lot of money, has ability to take risk, which we have determined, but his risk willingness is very low. So such clients, we educate them to make them understand that, see, you need to take risk in order for you to be able to build your wealth. Then we also have the other spectrum where you have a low ability, but your willingness to take risk is very high, which are the guys that go to bet. We also advise them that if you continue at this space, after a while, you realize that you don't have any money. Then obviously, people that's falling in both categories are easy to understand. So your ability to take risk is low, your willingness to take risk is low, that means you can't take risk. Your ability to take risk is high, your willingness to take risk is high, that means you can take risk. Or you are pretty much on an average. So basically, within that spectrum is how we play to understand and determine our client's risk appetite or risk tolerance. So yes, I 100% beyond what I've said, or in addition to what I've said, I also agree with what Femi had mentioned earlier.
All right, thank you very much. That's really eye-opening. The fact that there is the ability to take risk and there is the willingness. So even understanding your risk appetite is not enough. There has to be the ability and of course being willing to take the level of risk or the extent of risk that you are exposed or you're supposed to be exposed to. All right, I'll move to Ikechi now for our next question. I know that in Nathan's presentation, he talked about biases, he talked about different issues that could affect people's risks and investment decision. The brain sending messages and all, he made that allusion. I just want to ask, how do biases like overconfidence or loss aversion shape our investment decision, right? Issues like, maybe just what Ahmed had mentioned around being very willing with no ability, right? How does that shape our investment decision? Being very overconfident or being averse to making losses?
Thank you. I know you mentioned two groups of people, overconfident and then high risk. I'm going to add one more group to my answer, which is the no risk. So it's either people who they've been burnt before or they have generational PTSD from the market crash that happened well before they were born. I remember having a meeting with some of the executives within the exchange, and then they were telling us a story about when they went to visit a man. So capital market operators went to visit a man, and he was just looking at them and said that if not for God, he would have kicked them out of his house, because some brokers, rather, because of what happened in the last thing. And another aspect would be people who have gotten their hands burnt through the illegal means. I won't say anything more than that. I know that the most recent one that keeps coming up, Michelle, I'm tired of saying their names, but I know that we all know them. And one question that kept coming is, oh, do we have this amount of money in Nigeria? And the capital market, Nigeria capital market, is saying, oh, we are looking for investors, we are looking for investors, and this money is just going away. And some stories really broke my heart, because some people said, oh, they put in their rent that they'd been saving for years, because they saw that, oh, they could double it, and then instead of having just 1 million, oh, you have to, I can reinvest the 1 million, use the 1 million to pay rent, and then everything kind of went away. So you can see that there's a lot of different variations that are available when you are thinking about a different type of investors. The people who have said that, you know what, I do not want to hear anything investment again. So those people that got their hands burnt, I have a friend like that, and she said, after what happened, I don't even want to hear anything investment. Me, that I'm in the investment community, I just closed myself and said, I cannot even talk to this person about investment, because she's like, no risk, I'm not stepping in, let me just leave my money in the bank. And is that the ideal way to go? Not exactly. So I think that is why some of these sessions are critical and very important, because there's a need to begin to drive that trust within the people that have been burnt, people who have fathers that have been burnt, mothers that have been burnt. So begin to trust the system again, whether it was in the legitimate markets or the illegitimate markets, just to provide, the steps, the little steps to guide them. For them, their own is they are not interested, they are not doing, they are not putting any money in. They will rather be getting their debits every day from the bank than try or even learn about any instrument. And then let's think about the ones that are okay, fine. They are still very much averse, but they are willing to take that step in. Those ones, there's still a lot of hope for them. Those ones, they will most likely tilt to the treasury bills that we just talked about, because they are like, okay, if not for anything, I will definitely, I'm sure that my capital is secure, if not for anything. So you see that they lean more on more traditional, more sovereign backed areas. But just like our lead speaker said, building wealth that way is a bit more difficult. You need to be able to spread your assets a bit more. So understanding your risk appetite, understanding your risk willingness and your risk ability, that's something I learned today. Thank you for that, because you can have the capacity, not willing, be willing and not have the capacity. So being able to get yourself up to that point where you understand that, okay, I can put a little bit of here, I can put a little bit of there, I can put a little bit of there. So the way the biases affect people is that, one, they're a bit more slow to step into the market. That's for those who have higher risk, and they require all the support, all the guidance, all the information. I think that's where the capital market community comes in, driving the knowledge. I think in the past few months now, we are hearing more capital market operators putting out radio jingles on the radio. It wasn't like that maybe like last year, but now you're hearing them coming out, and people will start coming out of their shells because they're sure that, okay, one, this is legitimate. And once you hear, oh, regulated by the Securities and Exchange Commission, that adds a little bit of additional comfort for them. So on those ends, they you know, they come in little by little, or they stick to one asset that they understand, or they stick to one asset that they know someone is in. Okay, somebody is in this ABC Mutual asset management, and they have mutual funds. I trust this person. I can hold his neck if anything goes wrong. Let me just stay there. So it affects the way people act. Then on the other side, that's the flip side. Just like he said, the money is there or may not be there, but you are running to somewhere that gets you fast cash. The same way you can get fast cash is the same way you can get to zero very quickly. So it breeds a lot of maybe carelessness and throwing away everything you've learned, throwing away all your strategy. So definitely biases affect investors across board, whether they're overconfident, whether they're more afraid, or whether they've said, you know what, I'm not doing. So it definitely affects how investors come into the market.
Thank you so much, Nkechi. Well done on that. The same way you get quick money, the same way you can go to zero. Nathan, in 1 minute, can you just also add to that? What would happen? There are people on this call who are saying, I invested in XYZ platform and I made money before it crashed. So risk appetite or not, I've made it big. I can go in, go out, and all. Now, Nathan, in 1 minute, what would happen? What are the risks of investing without clearly understanding your personal risk appetites?
Okay, thank you, Vincent. So one very important thing when it comes to investing is the habits that we form. And the habit you form is difficult to change, which is why you see people who have gambling mentality. There's nothing you do that can change most of them. So once your habits are formed, it's difficult to change. So one needs to be very careful when you make investing decisions, because all decisions we take on a daily basis forms who we are ultimately. Which is why for many firms, we have this thing we call fit determination. So when we're reviewing a client, we want to even see if the client is a good fit for us and if we're a good fit for the client. And the reason we do this is there are people who just don't have the capacity to invest the right way. And no matter what you do, because their habits are already formed, So think about Ponzi schemes. I'm sure when you think about Ponzi schemes, there are people you remember. You remember their name. Because for every Ponzi scheme, they are involved in it. And they go from one Ponzi scheme to the other. Irrespective of what the SEC says, irrespective of what professionals tell them, irrespective of what common sense tell them, it's who they have become. So one needs to be very careful. I remember back in the days, one of my friends said, he asked me to, I was working in the bank then, he asked me to invest in MMM. You all remember MMM. And I said, no, I'm not investing. He said, no, that I have the money, because I think they had this thing where you bring someone and then I don't know how it works, but he needed me to invest. He had the money. He just wanted to invest with my name. I said, no, I'm not even going to give you my documents. The reason I don't want to give you is so you remember when it crashes that I told you not to do it. And ultimately, he lost money. So it's important for us to understand that for every action you take, you are forming who you are. And you want to be sure that you have the muscle memory to do the right things. If you wake up in the midnight, 12 a.m., you know exactly what is right for you as an investor. So you want to be sure that you are doing the right thing on a daily basis, because it's like playing a dangerous game. If you want to do the wrong thing because you get away with it, it becomes who you are. And suddenly, that is the only way you understand to invest.
All right, thank you very much, Nathan. I think that's spot on. Investing without understanding your risk appetite could help build the wrong habits, which may be very difficult at the end to change. That's why you get people saying they invest with their school fees, they invest with their children's school fees, hospital bills and other stuff, it's because they don't understand their risk appetite and they're not able to even be disciplined enough. I'll move over to Ahmed for the next question. Now, we are here trying to tell people about understanding their risk appetite. We've told people not to change strategies that are not aligned with their asset allocation strategy. Don't just change your investment allocation and all. But people want to make money. People want to do short term and just get in, get out. People want to also do long term. Now, how can investors balance short term market events with long term financial goals? I'm saving for the long term, my risk appetite, I just want to get there slow and steady. But I mean, some stocks are going up and down right now. If I had bought last week and sold today, all my money, I probably would double my allocation. So how can they balance short-term events with long-term financial goals? Very quickly, please.
Okay, thank you very, very much, Vincent. Your question is a bit packed, and I'm going to decouple it. Yeah. So first thing first is you understand your risk tolerance. Yeah, that's the first thing you do. Number two is based on your risk tolerance, you determine the investable assets that align with your risk tolerance. Now, based on those investable assets, you create what we call your strategic asset allocation, which is what you started with. So you can see that it's a build-up. Now, what is your strategic asset allocation? Your strategic asset allocation predominantly should align with your investment style, which we believe on a long term would help you achieve your financial goals. So you can see the flow. Your risk tolerance, very important, helps you to determine your investable asset classes. Based on your investment asset classes, you have your strategic asset allocation. So what your strategic asset allocation is just telling you is, this is how I'm going to allocate my wealth across these investment asset classes that align with my risk tolerance, such that if I invest my funds in line with this allocation, over a long term, I'm going to achieve my financial goals. Now, along the way, let's now imagine that, Vincent, I'm going to use you. Hello?
We can hear you. Go ahead.
Vincent, I'm going to use you as my test today. So let's imagine that after I've done all this for you, I've been able to agree that I'm going to do a 60% of your wealth in equities and 40% of your wealth in fixed income. And I'm telling you that over the next 10, 20 years, this allocation, if you invest in this methodology, if you invest in line with what I just said, you are going to achieve your long-term objectives. Now, the equity market is rallying significantly. As Nathan had said, we're at all-time highs. We're at levels that we have never seen ourselves to be. And it doesn't look like it's going to stop anytime from now. Yeah? Now, you come to me and you tell me, Ahmed, don't you think we need to put more in equities? Let's increase equities to about 20%, to about 80%. But remember that what I told you is if you do 60-40, over the next 10 years, we're going to be in a good state. But you have told me that equities is rising, so you want to increase it. Would I listen to you? The answer to that is yes. So there's something we call tactical asset allocation, where we intentionally deviate from the strategic asset allocation in order for us to be able to achieve some short-term goals, some short-term benefits. But the whole idea is after we achieve those short-term benefits and end those short-term benefits, we are going to take you back to the strategic asset allocation. So what I will technically do for you at that point in time is to reduce your allocation in fixed income and add to the equities. But the question now is, what equities? So that's where we can now bring in a concept called exchange traded funds, ETFs. So if there are ETFs that track the equity market, the Nigerian equity market. We have a few of them. What I would advise you to do is, rather than you determining if it is First Bank or GTB or Dangote Cement or Nigerian Breweries or Cadbury that you should be investing in, what I'll tell you is that 20% additional allocation, because it's a short-term strategy, I would advise you to what? To use that 20% to buy the overall index via an ETF, an exchange traded fund, because the whole idea is the whole equity market is going up, such that at the end of 3 months or at the end of 2 months, when we see that we have gotten that benefit that we want to achieve, what do? We sell or exit from the ETF and buy back our what? Buy back our fixed income instruments. Now, what you have done is you have not tainted that 60% investment that you had in equities earlier, but you have just used the ETF to benefit in a short term, such that after you have done what you want to do, you exit the ETF and go back to your fixed income, which is your strategic asset allocation. With this move, I believe that we won't have any issues. And we are not saying that because your strategic asset allocation is what we have told you is going to help you achieve your financial goals, that there won't be deviations intermittently, short-term deviations along the line. So for me, that's how we play it from a professional standpoint. And also, investors can also consider that in how they manage their portfolios going forward. Thank you very much, Vincent. I hope I did not go too academic.
Well, I think that left for the attendees, but I think it was really spot on. I think it was very detailed and clear, right? You've balanced it. There's discipline, and there's the fact that even in your bid to wait for long-term goals, you can make some tactical changes here and there and still meet with your objectives, which really makes sense. I'll move on to Nkechi very quickly. If you can just give me these 2 answers in 2 minutes, right? How should investors respond to emotional reactions like fear during market downturns? I think one of the panelists has spoken around how, I think it was Ahmed who spoke earlier about the rates of treasury bills in January and now and all that. Now, how should investors respond to emotional reactions like fear during market downturns? Also, what practical techniques can investors use to separate emotions from decision making? When it comes to money, emotions aside, how can you separate emotion from decision making, and how should we react to fear during market downturns? Very quickly, please.
All right, thank you. When I think about emotional placement when it comes to market shift and things like that, I always tell this example whenever I'm speaking to people about investments. A few months ago, I know that GT had one drama online with VDM and co, and I remember scrolling and enjoying all the videos on Instagram, on TikTok, laughing, and then like a week later I just saw a notification that GTB shares bounces back after whatever drama, and I was like, oh wait, instead of me laughing at the video, should I not be focusing on on the market at that time? So I think a lot of experienced investors, one of the things that they tend to do is watch the market, pay attention to trends that have been happening. Don't just panic move. Don't panic move. You're most likely safer in a still position, making a decision from a place of calm than making an emergent position just because there's a lot of rough waters. So my first thing would always be, okay, slow down. What is in my portfolio? How is my portfolio being affected by what is happening right now? What have the trends been for certain assets in my portfolio? Is it more stable? What are the projections in terms of the future? What are the experts saying about the assets going forward? I'm using the word assets now because coming from the commodities perspective, I will not just be talking about equities. There are commodity-backed instruments, there are gold instruments, and many other assets and many other type of instruments that have been talked about here. So using gold as an example, for people who remember the initial, when the war started between Ukraine and Russia, there was a spike in gold prices, and then not too long after, the gold prices crashed again. An inexperienced investor would probably have rushed out at that time because they saw it crashing, not knowing that in just a few weeks and a few months, gold hit its all-time high not too long ago. So the question is, in a market situation like that, do you panic move? And obviously, any expert will tell you, study the market, understand what the market's about, understand your portfolio, and it goes back again to your strategy. What is your strategy saying? Is this giving you room to add more assets? Is this giving you room to sell off more assets? Panic moving is never the idea. Nobody plays in the investment market as an expert panic moving. I think I'll also just add to what someone has said, because I've looked at the comments and the question keeps coming about regular people, people who don't have the millions to invest and things like that. I don't know if this is my closing question, but I'll just add to that, because I also saw it in comments and I was thinking about it, especially salary earners who already have the black tax, targeting their salaries well beforehand. I think one of the things that you have to know is that you don't need 1 million naira to enter into the investment space. There are a lot of assets that you can start coming in little by little, little by little, little by little. It may not be gold right now, because gold on the floor of the exchange is doing 130,000 naira per gram. But in the equity space, there are shares that are well below 1,000 naira, well below 100 naira, that are gradually have been doing well over time. So do not buy that idea that, oh, investment is for the rich. Oh, people, you must enter with 1 million naira. 5,000, there are mutual fund investments that start at 5,000, 10,000, even one small 1,000. So it's just to drive that narrative as well, because I know that we have more of a mixed audience, and probably we have people who are still learning and are still trying to grow where they are.
All right, thank you so much, Nkechi. Thank you for your response there. I would move quickly to Femi. Right, Femi, let's talk about robo-advisors and AI tools. How reliable are they in making investment recommendations? Right, on the back of that, I want you to also talk about how investors can use digital platforms to stay disciplined and informed in volatile times. I think a lot of the conversation today has been around discipline, having a strategy and staying disciplined. So how can investors use digital platforms to stay disciplined, especially in volatile times? And then tell us about robo-advisors and AI tools.
Okay, so thanks, Vincent. I'll start with the robo-advisor question. Let's break it down. At the end of the day, robo is for robots. Advice is for advice. It means a robot would look at you based on whatever questions you ask, whatever funds you have put forward, whatever risk profile you've come with, and say, on the back of that, I recommend go and buy XYZ stock. It's not going to be materially different from what you have today with your ChatGPTs and co, in the sense that it's as good as the training model that it has. Today, I think on the equities market, on a regular day, you do 19,000 deals. On a great day, maybe you do about 25,000 deals. That's not sufficient to train a robo model in this part of the world. Two, you have things like a CBN circular on regulatory forbearance that no model can predict with respect to highs and lows. So this is how I would recommend you take advantages of these things. Today, we all use ChatGPT, but when you type in the prompt, you still have to review so that it's not garbage in, garbage out. Yeah, it's an emerging trend. It democratizes access to financial planning. Democratizing means today, to come into the office, you probably need to have a G-Wagon with escort, and then before you are taken seriously. These digital platforms bring it down to you. So explore, learn, but please, it's still a bit early days to depend very heavily on it. It's the same market data that is available to us that it will be looking at, oh, this company typically pays dividends now. This thing is at its 52-year low and co. It's good as part of first line research, but to depend heavily on it a bit early. 2, digital tools with investing. At the end of the day, I think it was whether Banu or Nathan, or I think it was everybody had mentioned it, that consistency, the power of compounding, investing 10% of your salary every month will do you well over time than, oh, banks are rising, I jump in, I jump out, and things around that. Digital platforms, even if it's your banking app and you have so let me use Coronation now because I can speak to that authoritatively. Everybody has a dedicated VNuban. On your banking app, you can just set a standing instruction that says every month, take 100K once they pay my salary, give Mama Ahmed, give Mrs. Ahmed, and then put something in my money market fund. Digital tools can do that for you. 2, alerts, news, notifications, corporate actions, and all of that. A rights issue, for example, is a time-bound corporate action, meaning the company is saying, come and buy shares between this period and that period. If you were waiting in the olden days, you wait to receive something in your post office box. If you are waiting for that right circular to come to you, by the time it gets to you, you may have missed out on the opportunity. So it democratizes access to this information. It helps you do a bit of automated investing, repetitive investing. The future is robo. We are not there yet, but in the present, even triggers like, I thought you said you were going to do 40% equity. You're currently at 80%. It's time to rebalance. Digital tools can take care of all of that for you. Thanks, Vincent.
All right, thank you very much. So I want to quickly round up. So I'll take like one round of questions, then number of questions in the Q&A chat. But for attendees, be rest assured that the questions we cannot answer on the call, we will send a response to you. And also, of course, you can watch the recording again. Nathan, someone asked a question saying, you said when you want to invest in a company, you should do the fundamental research. What does fundamental research imply here? Very quickly, please.
Okay, so the first thing is that every company has a story. And for me, I have to like the story about a business before I put money there. And this is a very fundamental mistake that a lot of people make. You know, back in 2008, a lot of us were investing in companies that barely had office addresses. A lot of us were investing in companies that we had no understanding how they made money. We just saw a symbol on the exchange. It's making us 20% and we are buying. So it starts from understanding the story around a business. You have to like a business before you put your money into it. And that is simple for me. So the first line is that you have to like the story. If there's no story about a business that you like, then investing in it, to me, is like gambling. Now, once I like the story about a company, the couple of things that you now need to check to confirm and verify that story. First is that you want to make sure that this company is selling a product. And how do you know that? Check the revenue. Are they able to grow revenue on an annual basis? Because again, you're investing for the future, not for the past. So a company must demonstrate ability to grow revenue for you to, for that company to warrant investment, because you're investing in future cash flow. Again, I would look at the free cash flow. Revenue does not translate to cash flow, because you understand a company makes money and spends money along the way in terms of paying salaries, operational expenses. That will reduce the revenue a company makes. At the end of the year, do they have free cash flow that enables them to take advantage of emerging opportunities, whether within the same business or have alternative investments? So again, I like companies with very good free cash flow. Then you look at return on equity, return on assets. How efficient is this business? size hardly matters. That this company is a $1 trillion company may not matter so much if you drill it down to their ability to use the resources they have to generate revenue. How efficient is a company? You need to check that. Then I also consider leverage. Personally, I do not like companies that have very high amount of debt on their books. If a company is borrowing too much, it increases risk for me. And I want to stay away from such companies. So there are a lot of technical tools like this, that technical and fundamental factors that you have to consider before investing in a company. And for some investors, dividend is very important to them. Dividend. So you're looking at the company's ability to pay and grow dividend on an annual basis. Again, I'm careful with this. I'm saying for some investors, there are investors who are young, who want growth companies. They are not interested in companies that pay out every money they make as dividend. Instead, you're looking at companies that have opportunities to reinvest their profits into new areas to grow the stock price. So for some investor, dividend may be important. For some, dividend may not be important. So for me, these are some of the factors that I consider fundamental. And thankfully, a company like Coronation Securities has a very sound research team that would allow investors not to do the research themselves, but you can leverage on resources like the.
All right. Thank you very much, Nathan. Very quickly, Ahmed, is there a technique to move from being a conservative investor to an aggressive investor? I know there's a question around asset classes that typically suit each risk profile. So, but is there a technique, very quickly, is there a technique to move from being a conservative investor to an aggressive one?
So if you say an investor is conservative, then it means that the investor can't take risk. And if you think about it, it's all driven by your risk tolerance. And if you also think about it, it is based on your willingness and ability to take risk. So you can see the way I've drilled it down. So if you are moving from a conservative to an aggressive investor, then it means that your risk tolerance drivers have changed. Factors that drive or determine your risk tolerance have changed. Yeah. So for instance, your ability to take risk, for instance, has changed. So let's say I have put you as a conservative investor because of your ability to take risk, not necessarily from your willingness to take risk. Now, one of the factors of your ability to take risk is dependency. So let's imagine that along the line over the years, your numbers of dependencies have reduced for reasons best known to all of us. I really can't say. Yeah. Now, another reason is you've probably gotten a better job. So before you were working in a bank, then you moved to an oil and gas company, and the oil and gas company is paying you higher salary. So you can see how your ability to take risk has started changing. So when all these certain factors starts to change, it is when we can now determine if you should move from a conservative investor to an aggressive investor. The same way you can move from an aggressive investor to a conservative investor if certain peculiarities I have mentioned now about you, which I like to call your circumstances. So your client's circumstances have changed. And as a result, we can now move you across the risk tolerance spectrum. So it's not just waking up one morning and say, oh, now I don't like stocks, I now like bonds. Oh, now I don't like bonds, I now want to take risk in equities, or I want to move away from large cap stocks to small cap stocks. It doesn't just happen that way. Your circumstances must change in order for you to move across that investor spectrum. Yeah. Thank you very much.
Thank you very much, Ahmed. I think we'll just take last question for Femi. Femi, 1 minute. Someone was asking what robo-advisor they can use to monitor stock, and I just want to know what data points are most important for recommending an investment strategy based on risk? And also for first-time investors, Femi, what digital tools can they use to be empowered? I see you've tried to answer some of the questions, but of course, if you can speak to the best robo-advisor and also data points that are most important when recommending an investment strategy to based on their risk.
On robo-advisor, most of what we have here are still emerging. So I would say for now, just pause. Rely heavily on your brokers and the likes. What platforms? If you're an Access Bank customer, go to Access More from your convenient banking app. It's all there. If you're an equities customer on Coronation, just send an email. Someone will guide you so that I don't use up all of the time. And the third one, Vincent, with respect to risk, what's that question?
So it's around digital tools that can empower first-time investors or data points that are most important when recommending an investment strategy. So
for data points, yeah, I think we've flogged on what to look out and all of that. I will just distill it into relatable terms. The company I'm seeing today, will it be bigger tomorrow or less or smaller tomorrow? If it's going to be bigger tomorrow, please, by all means. He spoke to debt. If you're borrowing, one day the bank will come and collect the company. So too much debt is not really good. What are you selling? Are you selling a product that customs has banned and soon you go out of business? That's with respect to the revenue that he spoke about. There are returns. If you go into technicals, things like PE ratio, dividend yield, and all of that, yeah. Talk to a broker, talk to a financial advisor if it's your first time. Everybody always feels they know better than the market. Everybody always puts in 5K, gets 7.5, and say, I'm going to turn this 7.5 to $1. Who is $1 with my 7.5, you know? And then they make very risky bets. Talk to a broker, talk to an advisor. When you don't know what to do at all, just put the money in a fund, put it in an index. I think they use the word ETF, they use the word index, they use the word fund, or don't buy fixed income securities like treasury bills. 10K would always be 10K plus interest. As against, I'm going to buy this, I'm going to sell that, I'm going to put it in this. And then soon we'll see you in all town halls discussing stricter regulations for capital markets. Thank you.
All right, thank you so much. Thank you very much, our panelists. Thank you to our attendees who have stayed till this time. I know that there are a number of questions that are yet to be answered. We tried to answer over 30 questions. There are still around 30 yet to be answered, but we would get back to everyone who has asked these questions. To those who have questions and would like to ask them, please watch out for our email after this webinar. We'll send you an email with the recording, with the presentation slide from Nathan, and with some additional information that we can help you understand your risk appetite and find the right investment style for you. But if you still want to reach out to us, you can reach out to us on invest@coronationsl.com and someone will respond to you almost immediately. Before we invite Azizat for the closing remarks, can we just quickly pull up the slide on the Investment Academy? So I know we talked about learning, having platforms for you to learn. Do we have that up? Thank you. Femi, do you want to speak to this quickly?
Okay, thank you. The slide you were supposed to see is, again, I spoke to, this is 2 hours. For some of us, we need time. Some of us are at work now and just listening with our earphones. We have partnerships with exchanges. We have a partnership with the Commodity Exchange. We have a partnership with the NGX. There are so many questions around how do I trade? How do I start to trade? Scan the QR code, go and register. You join the waiting list. The course goes live very shortly. Everything we've discussed now is available there. Everything, all the questions with respect to fixed income securities and the likes are all available there. Self-paced, there are videos and the likes. There's one coming soon. I will not let the bell out of the cat because my partner is on the call with a major commodity exchange. So this is teaching shares, equities, ETFs, indexes, everything on the exchange. We'll roll out something teaching commodities. There's something on fixed income for everyone. Please scan, register, enjoy, and most importantly, invest safely. Thank you.
All right, thank you so much, Femi. Thank you very much. I'd like to quickly invite Azizat Awonuga to give us the closing remarks. Azizat, good afternoon.
Hi, good afternoon. Good afternoon, everyone. Thank you so much, Vincent. Okay, so my name is Azizat Awonuga. I'm team lead for products at trading at Coronation Securities. And as this session comes to a close, I want to extend our sincere appreciation to every one of you for taking the time to join in. This webinar has really shed light on an often overlooked but foundational element of investing, which is knowing yourself and understanding, your investment style and risk appetite. We hope that the insights shared today have really helped you to begin to identify your unique investment personality and how to align it with strategies that reflect your comfort zone with your financial goals, as well as your long-term aspirations. Heartfelt thank you goes out to our keynote speaker, Mr. Nathan Omonkoro, who is the CEO and founder of Savers Financial Services Limited. Your insights into investor behavior and psychology of risk have really helped us understand better the why behind financial decisions, made by investors. And to our panelists, Ms. Nkechi Obi, who is the acting head of operations at Lagos Commodities and Futures Exchange, thank you so much. Mr. Ahmed Banu, who is the MD of STL Asset Management Limited, thank you, sir. And our very own Mr. Olufemi Yoloye, who is the Chief Executive Officer at Coronation Wealth. We are truly grateful. Your expertise and practical perspective have added immense value to the conversation and provided our audience with a balanced view of how to turn self-awareness into smarter investing. We also really appreciate our moderator, Vincent, for facilitating such a thoughtful and engaging session. And of course, thank you to our audience for your active participation, for your questions. Even if we're not able to get to all of them on this call, we'll definitely, be reaching out and putting our thoughts, articles that would help further guide your investment journey. As we wrap up, I encourage everyone that's been on this call to really reflect on what has been learned today and actually apply it to their investment life and the journey. The best investment decision is not always the trendiest or the what's in vogue, what everyone is saying, but it's what is most aligned with who you are. And when you invest with that awareness, you invest with confidence. So thank you once again for being part of today's webinar. We look forward to connecting with you again. Have a great day ahead. And on our platforms, you can reach out to us via email, via social media. I'm sure the email for this particular session has contact information. So please feel free to reach out and, thank you very much for attending. Thank you.
All right, thank you, Aziza. Thank you to our panelists. Thank you to our attendees. Do enjoy the rest of your day and feel free to contact us for any other information. Have a great day, everyone.